Welcome to the Valuation Master Class case study, where you'll learn about interesting stocks and how to value them. What's interesting about TTM is that it currently trades at about a price to book of about 0.9 times. This is Andrew Stotts of the Valuation Master Class. Let's get started. And remember, this information is for learning purposes only. It's not a recommendation or investment advice. So TTM Technologies is in the infotech sector. It's a leading global manufacturer of printed circuit boards, or what's often called PCBs, with 29 specialized factories in North America and China. Funny thing, when I got out of high school, my first job was working at a PCB factory, and that was in Ohio. And they had the PCB area where they actually made the boards. And then I worked in the area where I would stuff the boards, basically. And it turned out I was the only man because it was all women that were doing that job because they were much more finesse than the men at doing that. So let's look at it in a little bit more detail. So the question we're asking, and I want you to try to answer this, is can TTM Technologies turn into a high profitable growth company? There's three things to know about the company. The first is that the growing U.S. defense spending boosts the core segment revenue. Number two, strategic divestments are going to drive future profitability, and China, poised to win the 5G race, is providing a growth catalyst. Some key statistics: there's 6 analysts covering the company, and their recommendation is $17 as a target price. That's an upside of 29% or a buy. So it's an attractive company right now to most analysts. The price to book is about 0.9, and the dividend yield right now is 0. My value estimate is about $15. That's about a 14% upside, and that makes it in buy territory from my perspective. Let's look at the sales of this company. The revenue breakdown: well, printed circuit boards are 91% of the business. There's not much else to say than that. There are a couple of other areas, but let's look at the end market here. We have 36% being sold to aerospace and defense, automotive 15, medical 19, networking 18. It's a pretty diversified revenue stream when you look at the final end market, which means that hopefully there's lower risk. Now, the price has turned bullish, and the signal, though, is staying somewhat neutral. Recently, the 50-day moving average has crossed the 200-day moving average, which is a good sign. If the 50-day moving average were to continue that upward trend, it could turn into a bullish signal. Now, throughout the past year, volume RSI has mainly stayed below the 50% line, and volume is not a support yet for the rally. If we saw volume coming in a long sustained support, it could have a good rally from here. So what's the story with this company? Well, growing U.S. defense spending is boosting the core revenue segment. And you can see here a chart looking at, on the left-hand scale, I have the revenue from aerospace, and then as a percent of total sales. So right now, about, let's say, as of 2020, about nearly $800 million was generated from aerospace, and that compares to 200 in 2014. So a big increase, going from 15% of total revenue up to now above 35. So TTM's recent focus on that fast-growing aerospace and defense segment has paid off. In 2020, the segment contributed 37% of total revenue compared to 16% in 2014. The company became an established subcontractor of the U.S. government, and so I expect that they're going to continue to get strong earnings because, after all, the U.S. government loves to spend on war. They call it defense, but really it's war. Now, strategic divestments to focus on growth segments. So here I'm also showing a chart of U.S. defense spending. This is in billions of dollars, and really right now it's getting close to $800 billion, just about to hit that mark. And defense spending in the U.S. enjoys bipartisan support. Nobody goes against the military in the U.S. Therefore, spending is likely to grow between 2 to 4%. Another characteristic of the defense industry is increased consolidation of suppliers. And with strategic M&A, TTM could get further exposure to the resilient industry, driving stable revenue growth. Now, number 2 is strategic divestments to drive future profitability. Now, you may be thinking, well, wait a minute, Andrew, strategic divestments going to drive profitability? That doesn't really make sense, because you'd think that investments are going to drive profitability. But in fact, they have one unit here, the mobility business unit divestment that we're talking about, and the proceeds from sale of its 4 manufacturing plants got them about $500 million US. TTM continues to reduce exposure to sensitive consumer and commodity segments to build a more resilient business. In 2020, it divested its mobility business, which was highly capital intensive. Also, it shut down 2 of its low-margin electromechanical solution plants. And as a result, 2020 revenue declined by 21% compared to the peak in 2017. However, net fixed assets shrunk by 36%. That's providing capital. So here you can see, though revenue has fallen, the demands for capital has fallen significantly more. So they're in a better situation from a capital perspective, but also sometimes you want to see a revenue decline and then you actually see a margin increase if it's getting rid of the right business. So rising profitability has more to give. I'm showing a chart of the gross margin of TTM, and the success of divestment should be already reflected in 2021 estimates that we see in the street. The gross margin is likely to reach 16%, which is 1 percentage point higher year on year. Now, over time, the company still has the ability to further expand that margin, and that's what I have in expectations. With a maximum of 16.5 in my forecast, I've been conservative, leaving room for positive upsides. The point is that the divestments and continuing to consolidate the business can drive up that gross profit margin even more. Now, the story number 3 is that China is poised to win the 5G race, providing a growth catalyst. So again, why would China drive TTM's revenue? Well, as of 2021, China has built more than 1 billion base stations for 5G, equaling about 70% of global stations. Continual aggressive expansion of 5G network could already lead to nationwide coverage by 2025. China is definitely fully committed to 5G. Therefore, we expect strong demand for TTM's printed circuit boards, and the management expects a 5 to 8% growth rate for this market, which seems realistic. Now, networking end market could become the second largest segment. TTM has 5 factories in China specialized in the production of PCBs. So 5G continues to put demand on those factories. Besides aerospace and defense, its products applied in network industry could provide a growth catalyst for the mid to term future. I think it's a great opportunity for TTM to beat market expectations. There's a lot of opportunity in China. Of course, there are risks in China, but as of right now, the company's been operating pretty well for a while. Now, remember, you can scan the QR code that I'm showing or just go to valuationmasterclass.com to download all full case study reports for free. Now, let's look at the Fvmr Scorecard. That's a measure of a stock's attractiveness relative to all other companies. Attractiveness is based upon 4 elements: fundamentals, valuation, momentum, and risk. The scale is from 1 best to 10 worst. Here, I'm just going to look at the valuation aspect, and let's look at valuation in a little bit more detail. Price to sales is about 0.7. PE is about 13 times. Price to book is close to 1 times. This company is relatively cheap, and that's what makes it interesting. Now, recently, I created a short online course explaining my Fvmr investing approach. I usually sell it for $97, but for a limited time, I'm offering it here for free. Just scan the QR code or go to the link below. Let's talk about the forecast. Again, I said there was 6 analysts covering the company with a 29% upside. All 6 analysts have a buy recommendation with an average of 29%. Consensus expects a robust revenue growth over the next few years. I'm highlighting this in the graphic just to show about 5% revenue growth each year over time. I believe that the company can expand its margins significantly. Right now, the margin consensus is between 17 and 18%. Let's review some of the financial statements. The P&L, the management plans to focus on more profitable and less cyclical end markets, and that should pay off as we see that profits start to rise. Already 2021 looks like about 100 million in profits. Now, 2020 net profit is distorted by the gains from divestitures, which you can see in this table is about $108 million. And that doesn't come in, obviously, in 2021. So the bottom line of recurrent, let's say because of non-recurring charges, is down at $96 million US, but still not bad. I expect consistent growth in profit from 2001 onwards. Now, let's look at the assets of the balance sheet. The net fixed assets decreased as a result of the divestments. This leads to a solid cash position, which is at about 450 million US dollars. Let's look at liabilities here, and we can see that the company has a healthy balance sheet. And in fact, it's paying down long-term debt from $1.2 billion down to 843 million in 2020. And I think that that's going to probably level off at this point. So net debt to equity is 0.3. Really, that's almost no debt when you consider it in relation to the cash. Ratios, well, just look at the revenue per asset, and we can see it's rising. It's going from 60.8, meaning 60.8 of revenue for every 100 of assets. And I'm expecting that's going to continue to rise in 2021 to 74 and stay about there for 2022. Now, other ratios, gross profit margin, I'm expecting it to be at about 16%. I would say I'm a bit conservative. It could go up from there. Now let's look at the valuation of this company. And I'm going to go through the A Stocks Investment Research stock picking checklist. It's inspired by Peter Lynch's 10 baggers, which was coming from his book, One Up on Wall Street. Now, it's based upon our extensive research, and 9 factors drive long-term performance. So let's review the 9 factors for this company. Factor number 1 is management. Management has a proven commitment to growth. What's the potential there? Good. The management has aligned its focus on fast-growing and more profitable segments. Point number 2 is growth. The product and the industry can support a decade of 10+% annual growth. Moderate. Most of the end markets TTM serves are resilient. We could expect mid-single-digit growth. Number 3 is sustainable, meaning competitive strategy creates sustainably high gross margin. Good. Divesting low-margin segments and shutdown of unprofitable factories can lead to margin expansion. Number 4 is quality. Good earnings quality. Non-core items are small or non-existent, and that's weak. In the past, earnings fluctuated quite a lot. Efficiency is the next one in the long run. Sales grow faster than assets, and that's weak. The company is characterized by a low level of efficiency. Asset turnover is about 60 to 75%. Tight, relatively low cash conversion cycle. Negative is best. That's moderate. Cash conversion cycle is moderately high and stood at 43 days in 2021. And cash flow. Operating cash flow is consistently positive. That's good. Operating cash flows have been consistent over time, and we're able to cover investing outflows. Number 8, capacity. The company has access to capital to fund growth. That's moderate. Leverage is moderately high. I would say on average, it's not too bad. And number 9, inexpensive. Valuation is reasonable. We want to avoid very expensive stocks. That's good. It's cheap on both a PE and a price to book basis. Though ROE is a bit low, it still is reasonably cheap. There's Hillary, and welcome to everybody else who's listening. Hopefully, if you have any questions, feel free to leave them in the comments. Now, let's go through the free cash flow for a bit. Free cash flow is likely to grow consistently over time in line with higher profits. And now to go through my forecast assumptions, I'm assuming about a 4.5% revenue growth and about a 16% gross margin. I'm just being more conservative right now than the other analysts out there. I expect similar revenue growth. And despite the management's efforts to become more profitable, I think it still has a ways to go. I'm going to think that there's more potential positive upside. And here, let's review some of the inputs to the free cash flow of the firm valuation. I'm looking at a cost of equity of about 11%, a WACC of about 8.7, and then a terminal growth of 2. So what's the value estimate? Well, $15, that's an upside of 14%. The bull case is up to 29% upside, and the bear case is 0. So it's a pretty reasonable bet at this point. Let's review the company's world-class benchmarking scorecard to understand the competitive position relative to global peers. We use a composite rank of profitability and growth called profitable growth, and we scale from 1 best to 10 worst. Here we can see, it's interesting, there's an improving trend. I'm benchmarking this company against 700 large infotech companies worldwide. And basically in 2019, the company was ranked a 9, meaning poor, very poor performance. Then it went to an 8 in 2020. And for the past 12 months, it's up to a 7. This is the kind of stock, if they can keep this momentum going, can really produce upward gains in the share price. If it could move to 6 or to 5 or to 4 over the next couple of years, that can drive share price performance. So where is it coming from? It's mainly coming from EPS growth. We can see profitability is still ranked at an 8. That's pretty low profitability. But that's also the reason why I think you can be optimistic that this company could expand its profit margins. And if it does, we would see that the profitable growth score could rise. So what are the risks? Well, adverse regulatory changes, especially in China, could hamper the business, and failure to meet quality standards and reliance on suppliers and dependency on top 5 customers, which make up a third of total sales. The conclusions are management strategy could lead to higher profitable growth. Healthy balance sheet can support expansion of core segments, and valuation is attractive. It might be a cheap opportunity to buy. Those are my conclusions. And just to answer one of the questions I see from Yash Mehta, is this live? It is live right now. Welcome to the live show. This is Valuation Master Class case study. And now I'm going to end by asking you, do you think that TTM Technologies can turn into a high profitable growth company? What do you think? Leave your answers in the show notes. It's great to have you on board for the case studies. I'll see you in the next one.